the recession is a baseball game, the inverted yield curve and unemployment peaking is like batting practice.
When the market crashes, we're not necessarily talking about the housing prices.
Yeah. What I wanted for my house a year ago and what I'm getting for it today is like astonishing.
Interest rates historically, they're still at all-time lows. All right, so we're almost through Q3. And so let's bring the great people of America, Steve, up to speed with what is happening with mortgage and the housing market. But good morning to you, first and foremost.
Morning to you.
So
it's seeing on my computer screen.
Yeah, it's a great day. It is the first day of the 2022 F1 season, just as a side note. But anyway, I digress.
About that.
Me too. So let's talk about the housing market.
You know what the best part of F1 is? Is you don't have to watch football anymore. Like we don't have a good football team in our hometown.
True.
We're in Detroit, so like the frustration of a bad football team is immediately washed away by watching Formula One. And I mean, we have our guys that we like, but they're all like European and stuff, it's not like as intimate. You can't see their faces when they're like driving. So it's totally easier on the emotions too on Sundays.
That's a good point. That's a really good point. All right. So I'm going to just kick this off talking about the same, I guess, challenges that we're having in this housing market. And one of those being inventory. Yeah. So you're going to talk about, I want to get your glimpse. I mean, on the real estate side, we can't find anything. We're having to bid. Buyers are having to go through 10 or 15 properties to get an offer accepted. We'll talk more about that. But the bigger issue is, well, how does this get corrected? How do we get more inventory in the market? And you and I both thought that one of the things that would relieve this inventory problem is new home construction. And a report came out yesterday that lumber prices doing nothing but continuing to skyrocket. And that, in addition to rising mortgage interest rates on these new construction prices that are just the highest I've ever seen since I've been in the business ever. You're building a house, know this better than anybody. And the builders are saying, I don't know. I don't know if we're going to be able to build the way that we wanted in 2022, the way that all the economists said, hey, if we can get new construction underway and get the supply chain stuff figured out, we'll have some inventory. We'll have places for the baby boomers to downsize, but doesn't look good right now.
Yeah, I agree with you. It's a challenging time, especially with building. And again, it goes back to so the Fed met this week, right? And so we go back to inflation and what are we doing to inflation and to fix inflation? But more than inflation, the conversation is still who's to blame for inflation. You know what I mean? So it goes back to this argument that's not solving anything. And the tools, like I always talk about our toolbox that we have to solve inflation, a lot of those tools are handcuffed now, because now we're in a war where we're in this, our government's overspending, right? Our government spent a ton of money to stimulate our economy. Our government's spending and doing this and this and this. Now we're having to send for humanitarian aid, right? We're sending hundreds of billions of dollars overseas to help these countries. And it's like, it's the right thing to do, but at the same time, or maybe it's not the right thing to do. That's not an opinion, by the way. This is the zero opinion zone. But I don't know any of that. I'm not smart enough to know how all that works. But what it does though is the United States government and the Federal Reserve, what they really need to do is ramp up interest rates, right? So this first hike really should have been a 0.5 point increase in rates, and they had to pare that back down to 0.25% increase in the Fed funds rate because of the turmoil in Ukraine right now. And what happens with that is, and this is this is going really deep, but like oil and gas and things like that, they're traded internationally based on the United States dollar, right? Yeah. So if the United States, if we raise our Fed funds rate, we're basically, why do we raise interest rates on mortgage, right? We raise interest rates to give a bigger yield, make it cost more, so it provides a bigger return to borrowers, right? So if we raise the Fed funds rate, that's raising the value of American money. So now these other countries have to convert their currency to American currency or United States currency to purchase gas and oil, it hurts their economy even further, right? So we can't come out and be like, hey, let's rescue our economy and go full bore and then throw the rest of the world off track.
Yeah, makes
you
sense.
know?
And that's the big thing about today's video is really the Fed, the March Fed meeting, you know? And so to your point, they said, okay, we're not going to raise rates the way that we thought we would. Were there any other big takeaways from the meeting that you think are worth mentioning?
I mean, and this isn't like that big of a Main Street America conversation, but they did mention that they're going to do their balance sheet runoff, which is where, you know, the Federal Reserve has been buying treasuries and mortgage-backed securities. And as I feel like I'm being redundant, but maybe out of the million people, maybe not everybody's a returning customer to us.
Exactly.
So the Fed's been buying mortgage-backed securities and treasury notes. And what they do is when those things mature, like any savings bond would, right, to simplify it from your bank, you get money back and then you get your principal back and then you get your interest. So what the Fed's been doing is when these bonds mature, they're just rolling that over along with their return, right? And so what the Fed is talking about doing is no longer rolling that over and just keeping the money and pulling themselves out of the mortgage market some, just to create the market, right? To create a true supply and demand based market. Now, how will they really be able to do that? My thought on that is probably not. So, and the reason is, and this can be a whole nother topic, but is the looming recession. So there's certain economic indicators that say, hey, a recession's coming. And one of them is when unemployment claims peak at their lowest, right? So when there's the fewest people filing for unemployment, once we hit bottom on that, when you bottom out on something, where do you go next, right?
Yeah.
We're talking about anything in life. Like once you hit rock bottom, you're only going to go up, right? So as unemployment is going to start to go up and we're seeing inflation rise. So that's one, right? So now we're seeing wages are not keeping up with inflation. So things are costing more, jobs are paying more, but there's a margin in there. It's my favorite one called the misery index. Nobody thinks it's funny except for me. I guess I'm the only one that gets like that econo jokes. But so there's that's looming, right? So this gap, and then there's going to be layoffs. Like companies are going to have to pull back because people are going to stop spending money, right?
Yep.
So that's happening. And then the other thing that's happening is you have your 10-year treasury. So that's down here like this. And then what's happening is the Fed is raising short-term rates. So when the long-term rates pay out a lower yield than the short-term rates like this, the short-term rate, the long-term rate pays out a higher yield than a short-term rate. It's called an inverted yield curve. And so now as these things start to invert, that is like one of the biggest precursors there is to a recession. I think of it like if you're going to, if the recession is a baseball game, the inverted yield curve and unemployment peaking is like batting practice.
Yeah, no, that's a good point. And the thing is, you know, the recession is much more likely than housing prices to crash, because the thing is, when we look at the Great Recession, right, of 07, 08, it was a housing induced recession because of the housing inflation, right? The values in relation to people foreclosing on their properties was the cause of the recession. Yeah. And now it's important for people to understand that they're not always correlated. And that's what I think people are really, really having a tough time understanding is like the buyers out there, right? And they're saying, well, I'll just wait till the market crashes. Well, when the market crashes, we're not necessarily talking about the housing prices, right? And I want your take on that. Like, so the recession that I think is absolutely on its way. I mean, again, we've talked about this for 3 months now, that the reason and the economics behind why a recession helps us with inflation, that doesn't correlate to lower home prices. What is your take on those two things?
So, you know, you said, the 2008 recession, or the great, whatever you want to call it. So there, I'm going to talk about in a second, the why that happened. But historically, that's the only time that a recession has ever impacted housing that much. Actually, in a recession, housing is considered, and real estate is considered, a very secure investment because it's a flight to safety that we talk about, right? Because we know that in a recession, people are going to spend less money. So when people are buying less and less $110 leggings, the value of that company that manufactures those leggings at that great margin is going to start to go down. They're going to pull their money out of that stock market and they're going to invest in like real estate investment trusts. Maybe they're going to take their cash and buy real estate and things like that. But here's what we have to go back to. And I was like a boots on the ground guy, right? Like I was there. I lost my whole mortgage pipeline during the recession in 2008.
Yeah.
And it goes back to a lesson that was very, very hard learned, right? And I don't even know if that's a good expression, but it was, and there's tons of regulation now. There's the Dodd-Frank Act, there's the CFPB, and all these things came from this. And this isn't regulating the people buying houses, and this isn't regulating what people are selling houses for. This is regulating the financial backing of these loans, and then what is used to determine whether you can do a loan. So if you go back to 2007 and 2008, they were putting people in like a lot of, so there's a 30-year fixed stuff, and they were great loans, and there was the FHA loans, and they were fine. They weren't quite as prominent because what you were doing is you could go out and you didn't even have to have a job. There's like a no income, no asset loan, right?
Yeah.
And so what you could do is you could charge those people a premium because they had no other options, supply and demand, right? There's only one set of loans that's going to give you a loan. So what do? You put them in an ARM that's fixed for 2 years. And then it has a prepayment penalty that keeps you in that loan for 3 years. And then they also give you an option to forego paying interest. You can just add your interest to the back end of your loan, which is called negative amortization. Well, why were lenders making these loans? Because there were big groups of investors coming out and saying, hey, if you can get me like a 7.5% to 8% guaranteed return for 2 years, and then if they pay it off before 3, you can get me another 25 grand on that. We'll buy all of these that you have. And there's this huge appetite for snapping up all these loans. And these guys, what they're doing is they're taking these loans, they're putting them in these big buckets, and then they sprinkle a few high credit, good loans on top of it. And it makes it look like a medium risk bucket. And there's just no regulation. So they're just making money hand over fist. Well, pretty soon, all of a sudden, all these banks, as these properties were starting to maximize and these ARMs were coming due and people couldn't afford the payments anymore, we started seeing homes go into foreclosures. Well, then on top of that, banks couldn't refinance them because all these investors that had an appetite for risk are now going bankrupt. There's nowhere to put the loans. So it started with this big appetite for risk on Wall Street. And there was a huge lesson learned. If we go back to the market today, the housing prices are, yes, going up because there's a severe lack of supply, right? We know that. And we also know that there's the largest population in American birth rates are now coming into the housing market as first-time home buyers with the highest wages we've ever seen. And these kids I shouldn't say kids, these people that are buying homes are 33 years old. These aren't 19-year-olds out of college making 46 grand, answering phones at Edward Jones. Like these are people that are engineers, pharmaceutical reps, people working in the medical field that are making $90,000 to $100,000 a year. Like we go get married, make $180,000 a year. That's $15,000 gross a month. After you pay all your taxes and your investments, you're walking around with 10 grand in your pocket to spend on a house. You get a $300,000 house, spending $2,500 on a house payment. That's not a recipe for disaster.
Right.
That's like the new normal, you know?
Yeah. No, these are all really good points, man. That was a great explanation of just understanding then versus now. Yeah. And understanding, again, the biggest takeaway that I want people to take from today's episode is housing prices. I just cannot, there's just no part of me right now that can see housing prices going down. I just don't see it. And so, because the questions, again, we get it 45 times a day. Should I wait to buy? Should I sell now? These are the boots on the street questions that you and I get every day, every second of every day. And there's just no, it doesn't make any sense to wait for something that just probably won't happen, but you are going to add something to that.
Listen, so what's happening right now is insane, right? Like 20% year over year in appreciation of property values. Like I'm in the process, like you said, of building a house, and I'm selling a house. And like what I wanted for my house a year ago and what I'm getting for it today is like astonishing.
Yeah.
And it's a good value.
Yeah.
But did I lose my train of thought? I had it. So the value is going up year over year. 19, I was just all excited. I'm like, I'm going to buy an expensive belt or something. I'm just kidding. So don't make those investments right now. So there's this 20% value thing. But even if you go back, like, I think that's going to cool off. Like, that's starting to cool down in the rising rates are going to start to cool that down.
Yeah.
I don't think it's going to slow things down a ton. I think it will cool things off a little bit, but you have to think about it. Even if you go back to what would be considered like a very reasonable or conservative estimate of property appreciation, which would be maybe like 4.5% to 5% a year.
Yeah.
So let's just say 4%. If you buy a $600,000 home and it goes up 4% a year, your home is going up by $24,000 that year on something that you're paying, nowadays, maybe 4.5% to own and maybe $50,000 out of pocket. If you go back and calculate the rate of return on your money, you're doing pretty damn good. And if you look at what rent has gone up, like an apartment that maybe was, $1,500 is now $2,200, you're looking at 150% increase in the cost of throwing your money away rather than, the value of paying more in interest, which is maybe 1.5% compared to last year, which was like insanely all-time lows. Like, it was like dreamland for like a year and a half.
Yeah, I mean, this is kind of what we're trying to explain, right? So you can see my camera trying to focus on that. Yeah. So to your point, prices have gone up 20%. We're not saying when we look at housing prices, they're just going to level off, right? They'll probably go up again this year, 4 or 5%. They'll go up again. That's what we're talking about, right? We're talking about them just not going up again the way that they have. But nowhere in any economic forecast do they have the trajectory go the other way. They're not going down. And so all the people, please, I'm urging you. I mean, you keep waiting to buy a house, and the only thing that you're waiting for is for the house to be more expensive and the mortgage interest rate to be higher. I mean, that's the only thing I can probably almost guarantee you that waiting gets you. That's it. If you wait to buy a house, the only thing I can probably tell you is you're going to pay more for the house, and there's going to be probably more competition, and your interest rate is going to be higher. That's what I know. And so I don't know. I just keep trying to get people off the fence that waiting and trying to outsmart the market. It's impossible. Right. You just can't. You're just not going to do it.
And I think a lot of that, and we were just talking about this before we jumped on here, is that there's, and we see this with like posting on social media and stuff. There's so, like, you can tell there's some people that engage and they're understanding the market. And they want to find a fit for their family and their budget, and they want to make a move and make a change. Then there's another population out there that is so caught up in the media, in the news, and these headlines. Cause you have to think, like, nobody's going to click a headline that says like, hey, interest rates are back to where they were before this, like, once in a 2 million year pandemic, and everybody was forced to not work. Like, now rates are just going to go back to normal. It's like, no, rates are skyrocketing. Like, the Fed raised interest rates 0.25%. Wait till you see what that does to your credit card bill. Well, if you owe 10 grand on a credit card and it goes up 0.25%, it's $25.
I know.
250. I don't know, whatever. It's a small amount of money. That it's actually changing, but people get it in their head. They're like, oh my God, things are going up, and like, what's going to happen? And immediately, like, nobody is ever like, yeah, things are going to go up, but like, let's just keep a level head and see what happens. Everybody's like, oh my God. You know what I mean?
Yeah. I mean, dude, you're exactly right. And I guess that's a good way to end today's show, is like, what the perception is on the media, that the media puts out there, and then what happens in real world on so many levels. I think about this all the time, on like how things appear in the media and then how they actually are just light years difference. I mean, I'll give you a great example. I'll give you one really good example. So, I think that things outside of our country, for whatever reason, maybe it's a bad perception. It just is. We had friends that work for General Motors, and they lived in China for 3 years, right? And I had this perception in my head of what I thought it would be like in China, like a communist country, and and you get outside and insanity. What is it? Yeah, just all of that, right? And he comes back. I'm like, how was it? Like, how was it? Fully expecting, Steve, for him to tell me all these negative things. You know what he told me? It was the cleanest place I've ever seen in my life. They have people on the highways planting flowers, watering flowers. It was so clean. The schools were amazing. The people were great. It was the best. I mean, it was like, man, this perception of media, right? That was just an example. I think about that all the time because I'm like, man, I would never want to live outside of the country. I just feel safe here, you know?
Yeah.
But then you talk to people, they're like, man, it was better than the United States.
That's a great example. I mean, there's a million of those. I mean, nothing proved that point more than the pandemic when you were watching the news and they were like piling bodies up and like showing all that in the hospital. And like, I can remember I was afraid at first. I'm like, my wife's like, well, I'm not going to the grocery store. I'm like,
I know,
I weigh 230 pounds. I'm going then. I got to eat. And I go there and it's like, oh, hey, how's it going? Like, oh, we're checking
exactly
out. Like,
right.
Nothing was insane, you know?
And the hospital thing, right? I'll just, one more really good example. Like, yeah, like the perception is like all these hospitals are filled with people, you know, with this pandemic. And for whatever reason, I had a friend that went there. She had to get twisted her wrist or sprained her wrist. And she's like, there was not anyone there. I'm like, is anybody here? Yeah, there was like not anyone at the hospital, zero. So I guess the point is why we're saying this is as it relates to our lane, housing in the mortgage world, just what the media, the perception media gives and what things are actually like on the street, they're just different. And, you know, with mortgage interest rates, there's nothing to be scared of. Like you nailed it early in the show. Wages are way up. So affordability is fine. Everyone talks about housing affordability. Interest rates historically, they're still at all-time lows. People are making more money than they've ever made ever. And so when you actually look at the payment, this is again, back to your point, the buyer says, wait, that's fine. I can do more than that.
Yeah.
Fully expecting to talk to you based on what the perception of the media, thinking they weren't even going to be able to buy a house anymore.
Right. And we have a lot more educated consumer today. Like the days gone by were so complex. And I wrote, so it's been like 2 years, but I did, and I talked to you about this the other day. I wrote an adjustable rate mortgage. You know, I talked to a client and they were going back and forth and they were very interest rate sensitive. And I was like, what's your plan? And they're like, we plan to move in this house. It's our first house. I don't know if we'll be here forever. And I'm like, look, here's your rate on a 30-year fixed. And with their scenario priced out at 4.5%. I said, here's an adjustable. It's a 7-year arm that prices out for the same cost at 3.875. I'm like, the different interest on that in your $240,000 loan is over $100 and something a month, whatever it was. He's like, yeah, but aren't those dangerous? I'm like, well, they can be, and they were, but let me explain exactly how this works. I'm like, your interest rate is fixed for 7 years. And during that 7-year period, you can do whatever you want. You can sell your home, you can refinance your home, you can take out equity, you can do whatever you need to do. Your home's going to go up in value. You're going to pay your loan down just like a 30-year fix. It's just at month number 85, your interest rate will stay the same. Your interest rate will go up or your interest rate will go down. One of those three things will absolutely happen. And we will be able to predict in year 5. We can look at you and we call, my company is different. We call every 90 days. But we'll review that with you. Like, hey, if this adjusted today. So, I told him, I said, if you were in a 7-year arm today and it was adjusting, if this was month 85, instead of 3.875, your loan would be at 3.05%.
Great.
Based on the single overnight finance rate is what they use now. And it's a 30-day average. So I'm like, you're like, yes, it would adjust every 6 months, but that's not necessarily the end of the world. And here's what the payment would be on that. And it would still be less than what it was on the 30-year fixed. And you're paying your loan down more and you're saving money and interest. So I'm not saying that everybody should go out there and get an adjustable rate mortgage, but what I am saying is that number one, and we talked about this, right? The United States is the only country in the world, I think, that does 30-year fixed rate loans. And it's because it makes the banks a ton of money.
Yeah.
They don't do, and if you go to like a Canada or you go to Mexico or you go to, like, I've had clients that have had homes in Hong Kong and I'm like, how's that work? And they're like, oh, it's never fixed. It just floats according to this Chinese rate that they have. And they make one payment a year and it's like 2 million yen or something. It's a whole weird thing. I'm like, America's the only country that offers these locked in rates because they're the most profitable interest rates for banks and secondary markets. I said, and in like 18 years of doing this, I've seen somebody in a loan, maybe once a year, I'll see somebody that has a mortgage that's older than 5 years. Like things come up, interest rates go up, interest rates go down. You pay PMI, you get out of PMI, you add a pool, you add a deck, you finish your basement, you refinance. Nobody stays in loans that long. So I'm not saying everybody go out and get an ARM and you're going to ruin the economy, Steve, and you're going to cause this foreclosure crisis. I'm just saying, look at all your options and don't be afraid of that. I mean, 30-year fix came out when there was a need to make more money, not because people were losing homes, you know?
Well, yeah, this great point, man. Again, it's just another example of like the media's perception of what's good and what is bad, and then reality. Yeah. So yeah, let's just keep an eye on, you know, what's happening. We'll do this here in the next week or so. We'll bring new information back to the show. If you guys have questions, obviously let Steve and I know. You can use the comments if you want, and then we'll respond to those, and we'll see you guys on the next episode.
Great week.